These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. This week, the market reminded every participant why discipline is the only lasting edge. While the S&P 500 climbed to fresh records and the VIX eased modestly lower, the real story played out in the space between headlines and actual price action. It was a week that rewarded patience, punished reactive trading, and illustrated once again that the volatility risk premium is real, but only for those structured and disciplined enough to harvest it without overreaching. Let us walk through the full week together, slowly and deliberately, the way weekend reflection deserves. We will connect the daily moves into one continuous narrative. We will examine what the volatility surface actually told us. We will look at gold, the dollar, and crypto as reliable sentiment barometers, and we will spend considerable time on how the VIXShield framework performed, because that is where the deepest lessons always live. The S&P 500 opened the week at 7,109. It closed Friday at 7,165, a gain of just under 1%. That sounds quiet on the surface, yet the path was anything but linear. Monday saw the index open near 7,109 with the VIX at 18.87. By Tuesday's close, the market had dipped to 7,064 before recovering. Wednesday brought another test, closing at 7,138. Thursday saw the index push back above 7,100, and Friday delivered the weekly high, close at 7,165. The VIX, for its part, began the week at 18.87 and ended at 18.55. It traded as high as 20.5 on an intraday basis midweek before settling into a more comfortable range. Realized volatility, measured by 10-day historical volatility, stayed remarkably contained between 10.4% and 14.2%. That gap between implied and realized volatility is exactly what creates the structural opportunity many of you have heard us discuss. What drove these moves? The news flow remained dominated by anticipation around upcoming economic data and the steady, almost mechanical recalibration of Federal Reserve policy expectations. Headlines noted choppy but ultimately record-setting action in both the S&P 500 and the Nasdaq. Emerging market central banks, according to several respected observers, continued to align their policy paths with whatever the Fed ultimately delivers. There were no major new geopolitical shocks that broke through to sustained volatility expansion. Instead, the market absorbed scattered headlines, some of them timed with peak zero DTE gamma windows, and mostly shook them off. One flash that arrived on Wednesday at 1:47 p.m. highlighted a rapid move in zero DTE 7,100 puts, which moved from $1.30 to $6 in a compressed window. That kind of gamma acceleration can feel alarming in real time, yet when viewed through the lens of expected daily range and confirmed exhaustion signals, it remained inside the probabilistic boundaries our models monitor. The key discipline was refusing to adjust positions during the 1:30 to 2 p.m. Eastern Gamma window, exactly as the framework instructs. Now let us turn to the volatility regime itself, because this is where the week's character truly revealed itself. The VIX spent the entire 5 days in the high teens, never quite reaching the panic thresholds that would force a wholesale defensive posture. More importantly, the term structure remained in contango. That simply means longer-dated volatility was priced higher than near-term volatility, the calm, normal state of markets. At Friday's close, we saw the VXV, which measures 3-month volatility, at 21.30 versus the spot VIX at 18.71. That spread of 2.59 points is a healthy normal buffer. It tells us the market was not rushing to price an immediate catastrophe. This contango environment is precisely where credit spread strategies, particularly iron condors and defined risk put spreads, have historically found their edge. The volatility risk premium, that persistent tendency for implied volatility to overprice the tails relative to what actually materializes, remained intact. Our rapid skew AI scanner, which we refer to as RSAI, stayed in place mode for 4 out of the 5 trading days. Only Tuesday carried a hold signal, when intraday VIX briefly pierced the 20.5 level and the expected daily range contracted. That single hold day proved valuable. It kept traders on the sideline during the most uncertain hours and allowed the subsequent recovery to unfold without forced adjustments. Across the broader landscape, several other markets told their own consistent story. Gold, our classic safe haven and Fed policy barometer, closed the week at $4,740.90, down 1.37%. That decline coincided with a modestly firmer dollar. The DXY rose 0.46 on the week to close at 98.51. When the dollar strengthens even slightly, it often reduces the appeal of non-yielding assets like gold. At the same time, real interest rate expectations appeared stable, and there were no fresh geopolitical escalations capable of driving a sustained flight to safety. The modest gold decline therefore reads as a quiet confirmation that risk appetite remained intact, even if it was not particularly aggressive. The dollar's own movement carried implications for global risk appetite. A firmer DXY tends to weigh on emerging market currencies and can occasionally tighten financial conditions. Yet the S&P 500 still managed to grind higher. That combination suggests domestic equity strength was driven more by corporate earnings resilience and steady liquidity than by broad dollar weakness. In other words, the market was selective. It was not a universal risk-on move fueled by easy money. It was a measured, disciplined climb. Crypto offered its own read on sentiment. Bitcoin rose 1.6% on the week, closing near 77,583. Ethereum finished slightly softer, down 0.6% near 2,314. Crypto's modest net gains kept rough pace with the S&P 500, neither leading dramatically nor lagging in a way that signaled exhaustion. Institutional flows appeared balanced. Regulatory headlines remained in the background rather than dominating the tape. For those watching crypto as a high beta risk barometer, the message was one of cautious participation rather than euphoria. Beneath the surface, options positioning told a story of measured caution. Skew remained moderately elevated early in the week before compressing as the VIX drifted lower. That compression is typical in a grinding higher equity market. Put buying for protection never reached panic levels, and call overriding activity stayed steady. The zero DTE complex, which now commands enormous daily volume, created the occasional headline trap we discussed earlier, yet the broader open interest in longer-dated index options showed no signs of crowded one-way bets. The market, in short, was positioned for range continuation more than breakout or collapse. With that market context in mind, let us turn to how the VIXShield strategy actually performed. This is the part of our weekend conversation where we move from observation to application, because watching the market is one thing. Consistently executing inside it with defined risk and repeatable process is another. The framework rests on 3 interlocking components. First, the expected daily range, or EDR, which we calculate using a blend of implied and realized volatility to define high probability boundaries for the day's movement. Second, the adaptive layered VIX hedge, which we call ALVH. This is a rules-based overlay that layers small VIX call spreads or futures exposure when implied volatility breaches the 85th percentile. And third, the rapid skew AI, or RSAI, which scans real-time skew dynamics and issues either a place or hold directive for our core credit spread structures. This week, the numbers were straightforward: 4 place days and 1 hold day. On Monday, the RSAI issued place with the VIX at 19.11 and a modeled credit of $1.15. Tuesday's hold arrived when the VIX touched 20.48 intraday. The subsequent three sessions, Wednesday through Friday, all carried place signals, with credits hovering near $1.15 and the VIX gradually relaxing from 19.40 down to 18.55. What does that pattern teach us? It teaches the value of mechanical discipline over narrative temptation. On the Tuesday hold, several financial news outlets highlighted geopolitical headlines that coincided with a sharp but brief gamma spike in the 0DTE put complex. A reactive trader might have sold premium right into that move, chasing the headline. The framework instead kept us flat until the gamma exhaustion was confirmed and the EDR bias turned clearly forward again. That single pause likely preserved capital that would have been tested in the intraday reversal. When we did receive place signals, the iron condor structures were centered around the 7,100 to 7,300 zone early in the week, migrating higher as the S&P 500 advanced. The credit collected remained consistent because we stayed inside the 20 to 30 delta range and respected the 1.5% of portfolio capital risk limit per position. Those who followed the exact parameters, including the instruction to avoid adjustments after 60% theta capture, experience the statistical edge the volatility risk premium provides. We also continue to emphasize the advantages of SPX index options over SPY for those running smaller accounts or shorter dated spreads. The cash settlement, European-style exercise, deeper liquidity, and materially lower commission friction all compound over time. Several listener questions this week focused on 10-cent wide 0DTE verticals in SPY. Our response remained consistent. Those structures suffer from assignment risk, higher relative commissions that can consume more than 20% of the expected edge, and liquidity evaporation on tight exits. Switching to SPX, staying inside the EDR, and applying the temporal theta martingale only inside predefined drawdown bands produced far more stable results. One study we referenced again this week, drawn from more than 18 million SPY, put credit spread trades between 2018 and early 2026, continues to illustrate the point. Theoretical Black-Scholes models, assuming flat volatility, predict steady losses on those spreads. Realized profit and loss, however, averaged positive $1.06 per spread. The difference comes down to equity drift, volatility skew, liquidity advantages, and most of all, strict adherence to position sizing and exit rules. The VIXShield toolkit is engineered to systematize exactly that difference. None of this is guaranteed. We repeat it every single day for a reason. Past win rates near 78% on well-executed iron condors do not protect against the policy-driven volatility expansions that have historically arrived without much warning. That is why the adaptive layered VIX hedge exists. It is not a crystal ball. It is simply a disciplined, rules-based response when the market begins to price tail risk more aggressively than recent realized volatility would justify. This brings us to the discipline lesson that stood out most clearly this week. In an environment of persistent implied volatility overpricing, the temptation is to do more, to widen strikes, increase size, or chase the occasional headline-driven spike. The framework's single hold day acted as a circuit breaker. It forced a pause at the exact moment when emotional trading tends to peak. Those who honored that hold preserved their ability to deploy capital cleanly on the 4 place days that followed. The broader psychological truth is this: trading psychology is not about staying calm when the market is calm. It is about maintaining the exact same process when the market tries to lure you into narrative-driven decisions. Whether the lure is fear during a gamma spike or greed during a steady grind higher, the antidote remains the same. Pre-documented rules, written entry, profit target, stop, and time-based exit before any position is opened. No exceptions. Paper trading the full RSAI plus ALVH protocol until it becomes muscle memory. and never, under any circumstances, risking more than 20% of total capital on a single position. Taken as a whole, this was a week that quietly reinforced the central thesis. The volatility risk premium is not a theory. It is a measurable, repeatable feature of equity index option markets, driven by the structural tendency of investors to overpay for insurance. But harvesting that premium at scale requires far more than simply selling puts or calls. It requires a layered defense, constant awareness of where you sit inside the expected daily range, and the emotional discipline to stay on the bench when the signal says hold. New listeners, if this approach resonates with you, know that everything we discuss is built for capital preservation first and income generation second. We do not predict direction. We do not chase home runs. We simply try to remain on the right side of probability, week after week, using tools that have been stress tested across different volatility regimes. If you found this summary valuable, consider upgrading to Pro or higher for the full twice daily VIXShield market summaries, proprietary signals, and private RSS feed. Visit VIXShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This is VIXShield, your protection against market uncertainty.